Welcome to the Deep Dive, the show where we really try to cut through the noise, distill complex info, and give you those critical insights you need to be, well, truly well-informed. Today we're tackling a really fascinating question. What happens when a company's main business isn't actually making products, but owning other businesses? How do you even start assessing quality and value there? Our focus today is INVE-B.ST, ticker STOINVEB. It's described in the material we looked at as a centennial fortress. And our mission for this deep dive is pretty clear. We want to deconstruct its, intricate business model, its competitive position, and really see if it qualifies as a wonderful company, one suitable for owning over, decades, as the source claims. We've dug into a detailed investment memo, and we're ready to share what we found with you.
It is fascinating, isn't it? Because we're not just looking at one company operating day to day. We're looking at this whole ecosystem of companies, managed, nurtured, all under one roof, and understanding how all those pieces fit together, plus the philosophy behind it for over a century. That's really key to grasping its value. It's definitely not your typical stock analysis.
Right.
Which brings us to the central question for you, the listener. Can a company like this, a diversified holding company, actually generate superior returns long term? Or is it, at the end of the day, just sort of reflecting its parts, maybe with extra complexity? What's it mean for your investment thinking?
That's a massive question. And before we dive into the details, just a quick note for our listeners.
Right. For those of you who want to act on these investing ideas, having a professional grade platform is really key. We use Interactive Brokers ourselves, actually, and we've partnered with them to get our viewers a stock bonus when they sign up.
So you get a bonus and support the channel at the same time. That link is in the description, right?
Yeah, that's right. And of course, if you find value in this kind of in-depth discussion, the best way to let us know and to make sure you get the next one is to subscribe and like the video. It genuinely helps the channel grow. And if you have any questions about Investor AB or anything we discuss, please, manifest yourself in the comment section. We do read them.
Perfect. Now let's get into it. Pillar number 1, the business model. Okay, so let's unpack this. On the surface, it sounds simple, right? Owning other businesses. But the memo immediately points to this distinct 3-pillar structure. It's meant to balance mature cash generation with long-term growth.
Right.
So what are these pillars? How do they work together? And doesn't that structure risk that, conglomerate discount thing?
That's a very fair point. Conglomerates often do get penalized for complexity. But here, the argument is the structure is actually a strength. The first pillar, the real foundation, is their listed companies. This makes up about 68% of Investor AB's net asset value, or NAV. These are significant stakes, often controlling minority stakes in big global publicly traded companies, real champions. Think of them as the established giants.
Okay, the big public names.
Exactly. Key holdings like Atlas Copco, the industrial powerhouse, AstraZeneca, huge in pharma, SEB, the financial services group. And the value here comes from two places. Long-term capital growth, obviously, but also, crucially, a steady, reliable stream of dividends. That dividend income basically fuels the whole Investor AB enterprise. It's the engine.
Got it. So that's the solid base generating cash. Pillar 1, what's pillar 2? Where does the sort of future growth come in?
Right, that would be Patricia Industries. This is a pretty substantial chunk too, about 23% of NAV. And this is really the engine for incubating future champions. It's where they nurture businesses away from the quarterly pressures of the public markets. These are mostly wholly owned or majority owned private companies.
So these aren't listed.
Correct. The focus tends to be on defensive sectors, high-growth niches. Think medical technology companies like Moat and Permobile. Moat, for example, is a world leader in advanced wound care, really critical stuff for patient outcomes. Permobile does advanced rehab tech. And the value here comes from the operating profits and the cash flows these private businesses generate. The memo actually highlighted Moat distributing something like EUR 300 million in cash in 2023.
Wow, 300 million just from one private company.
Yeah, it shows they can generate serious value even while keeping these companies private, nurturing them.
Okay, so we've got the listed giants providing cash and these private incubators in Patricia Industries driving growth. Is there a third piece to this structure?
Yes, there is. The third pillar is investments in EQT. That's about 9% of NAV. This gives them strategic exposure to the wider private equity world. They hold a significant stake in EQT AB. That's a top-tier European private equity firm, and they also invest directly into some of EQT's funds.
Interesting. So a way to play private equity without doing it all themselves.
Exactly. It provides diversification within that asset class through a partner they clearly trust, and that performs well. Value comes from appreciation in EQT-AB shares, plus the cash distributions from those underlying funds.
Okay, so 3 pillars. Listed: Patricia Industries, private, and EQT investments.
Yeah.
Sounds very deliberate, very strategic. But the memo talks about simplicity and endurance. How does this seemingly complex 3-pillar thing lead to simplicity, and how does it contribute to their, 100-year track record?
Right. It seems like a contradiction, but it's not. The simplicity and endurance comes from the fact that this fundamental model hasn't really changed in over 100 years. It's survived wars, recessions, tech shifts. It's incredibly resilient. And the endurance comes from what these companies actually do. They're anchored in basic, non-discretionary needs. Atlas Copco. Industrial productivity. AstraZeneca, Moat. Life-saving treatments. SEBI. Economic activity. Saab. National security.
So core industries.
Yeah.
Things society needs.
Precisely. And they're often positioned for big secular trends, aging populations, digitalization, automation, electrification, things that aren't going away. And this structure, this is key, it creates anti-fragility. Most conglomerates get that discount you mentioned because markets see complexity as bad. Here, the structure is a strength.
How so?
Because of the internal capital flow. The steady, predictable cash from the big listed companies gets redeployed into Patricia Industries, into those high-growth private businesses. They can fund this growth internally without needing expensive external financing or exposing these, growing companies to short-term market whims before they're ready.
Ah, so it's a self-funding loop.
Exactly, a self-funding ecosystem. Mature businesses feed the growth businesses. That internal capital allocation, that efficiency is a massive competitive advantage. It's really central to their edge.
That makes a lot of sense. The structure itself is an advantage. But the source material digs deeper, calling the competitive edge a fortress with interlocking moats. What makes it so hard to copy beyond just owning good companies?
This is where it gets really unique. The fortress isn't just about the assets. It's about these interlocking moats, which are incredibly hard to replicate. They fall into 2 main buckets: intangible assets and structural advantages.
Okay, let's start with intangibles.
The big one is the Wallenberg network and reputation. This is the bedrock. We're talking over a century of building trust, stability, acting as a long-term partner. This reputation gives them access, preferential access to investment deals others just don't see. It helps them attract the very best management talent, and it gets them influential seats on boards.
So it's like an exclusive club almost.
In a way, yes, but built on genuine long-term relationships and results. This network is absolutely key to what they call their engaged ownership. They're not passive investors. They actively guide strategy from the inside because of this influence and trust.
That's powerful. Okay, so that's the intangible side. What about the structural advantages you mentioned?
2 huge ones here. First, permanent capital. This is a fundamental difference compared to, say, a typical private equity fund. PE funds have a limited life, maybe 7-10 years. They have to sell eventually.
Right, the exit clock is always ticking.
Exactly. Investor AB doesn't have that clock. They have permanent capital. They are never forced sellers. They can hold businesses through entire economic cycles, support them through downturns, make decisions that pay off over generations, not just years.
That patience must be a massive advantage.
It is. It allows them to compound value in a way that's almost impossible for funds with limited lifespans. The second structural advantage is low-cost operations. Because they're a self-managed holding company, they run incredibly lean. Management costs are tiny. The memo cited just 0.08% of adjusted NAV.
0.08%. That's incredibly low.
It really is. Compare that to the typical fees PE funds charge. This gives investor AB a permanent structural cost advantage. More capital stays within the company, available for reinvestment or dividends. It just makes the compounding more efficient. Minimal friction.
Wow. Reputation, permanent capital, low costs. That's a potent mix. Can you give us a real-world example? How does this moat in action actually look with one of their companies?
Sure. The Atlas Copco story is probably the best illustration. Atlas Copco is, world leader in industrial compressors, vacuum tech, a real crown jewel in the portfolio. Investor AB, being the largest shareholder with significant influence, has really shaped its success over the long term.
How specifically?
Well, take the 2018 spin-off of Epiroc, their mining division. Investor AB actively supported that strategic move. It allowed both Atlas Copco and the new Epiroc to sharpen their focus, and it unlocked a lot of value. That's engaged ownership, guiding big strategic decisions.
Not just sitting back and collecting dividends.
Not at all. And their presence on the board ensures management stays focused on long-term, high-return initiatives, like building out that recurring service business that's now over a third of Atlas Copco's revenue. Very high margin. And the result, look at Atlas Copco's dominance. Their compressor division is nearly 3 times bigger than the nearest competitor. Their profitability is consistently way above the industry, average unit margins over 20% versus maybe 14% for peers.
That really demonstrates the impact. Patient, influential capital, turning a good company into an exceptional one.
Exactly. That's the moat in action.
So the moat is clearly there. It's tangible. But is it static? Or is it actually getting stronger over time? What's the trajectory here for someone thinking long-term?
The analysis strongly suggests the moat trajectory is stable and widening. Think about it. The sources of the moat reputation. Permanent capital. Low costs, they're self-reinforcing. Every decade of success polishes that Wallenberg reputation further, attracting even better opportunities and talent. Every krona they retain strengthens that permanent capital base, giving them more firepower, more flexibility.
It feeds itself.
Precisely. And we see proof in the numbers. Consistently outperforming the Stockholm Index for 13 years straight through 2023. That's not luck. That speaks to an enduring, effective competitive advantage. So the conclusion is pretty clear. The moat isn't just holding steady. It's arguably widening as their scale, track record, and reputation continue to grow. It's a virtuous cycle.
All right, now for something a bit different mentioned in the report, this Scuttlebutt simulation. What exactly is that, and what did it reveal about the actual quality of the businesses on the ground?
Yeah, Scuttlebutt is that idea of doing on-the-ground research, talking to customers, employees, competitors. The simulation tried to capture that perspective, and it revealed a really interesting split, a dichotomy.
Okay.
On one side, you see really strong customer love for their B2B and med tech companies. Monley Healthcare, described as world-leading, high-quality, innovative wound care. Customers trust it, rely on it for patient outcomes. Atlas Copco, same story. Seen as reliable, high performance, essential for productivity, strong loyalty, pricing power. These businesses seem built on genuine quality and performance.
Sounds great, but you said dichotomy.
Exactly, because on the other side, particularly with their consumer-facing brands, you find evidence of customer tolerance or even outright dislike. Customer reviews for Electrolux and Husqvarna were often, well, pretty negative. Complaints about poor customer service, products failing, high repair costs. Yeah, the report quoted things like, worst customer service ever for Electrolux. And someone saying about Husqvarna, stay as far away as you can, you will not walk away happy.
Wow, that's harsh. So some great products maybe, but the overall brand experience seems damaged there.
It suggests eroded brand equity, definitely. It's a stark contrast to the B2B side.
A real weak spot then. What about from the employee's perspective? Did the Scuttlebutt offer any clues there?
It was more inferential on the employee side, but the report pointed to the remarkable stability in management. Average tenure for core management is 8.4 years. For the board, it's 7.6 years.
That is stable.
Very. And it suggests a strong mission-driven culture that retains talent. This aligns with the company's own messaging about professional development, impact, respect for people. So while customers might grumble about some products, the people leading these companies seem highly committed.
So we end up with this tale of two portfolios, truly world-class B2B and medtech gems, but then these consumer brands that seem to be lagging, at least in customer perception. What does this split mean for you as a potential investor? Is it a red flag? An opportunity?
It's definitely both. It's a clear risk. These weaker assets, Electrolux, Husqvarna, they could absolutely drag down the overall performance if things don't improve.
Right.
But it's also a potential catalyst, because this is where Investor AB's engaged ownership model really comes into play. They're not passive holders. The key question becomes, can management use their influence, their capital, their expertise to turn these businesses around? Or if not, will they have the discipline to cut them loose, to divest and redeploy that capital elsewhere?
Have they done that before?
Yes, the report mentions they've shown that discipline historically, selling off major assets like Scania, the truck maker, and OMX, the exchange operator, when it made strategic sense. So there's precedent for making tough calls. It's something to watch closely.
Okay, shifting gears a bit, let's talk about management specifically. The report really emphasizes their exemplary capital stewardship and this culture of rationality.
Yeah.
How does that actually show up in their leadership and overall philosophy?
It seems deeply ingrained. The appointment of Christian Cederholm as CEO in May 2024 is a good example. He's a company veteran, came up through Patricia Industries. It signals continuity, sticking with that time-tested philosophy. And you see it in their language. They constantly talk about future-proofing, long-term total shareholder returns. They don't seem caught up in quarterly noise.
More than just talk, though.
Well, consider the Wallenberg family motto. To earn money is a means, not an end. That sounds philosophical, but it has real impact. A large chunk of Investor AB's dividends goes to the Wallenberg Foundations.
Funding science and education.
Right. Exactly. Which creates this unique alignment. Corporate success directly fuels societal progress in Sweden. It reinforces that long-term, responsible perspective. It's not just about maximizing next quarter's profit. There's a bigger purpose, which likely encourages more rational patient capital allocation.
That's a really interesting dynamic, quite different from most public companies. How does this philosophy translate into their actual track record? How do they allocate the capital they generate?
Their approach looks very disciplined, very rational. First priority is reinvestment in the core business. They explicitly state they'll invest more in their existing portfolio companies when the valuation looks attractive. So doubling down on their winners when the price is right.
Makes sense. What about M&A acquisitions?
Acquisitions, M&A, seem mostly focused within Patricia Industries. They tend to do strategic bolt-on deals, buying smaller companies that strengthen their existing wholly owned businesses. Like PIAB buying Coval or Advanced Instruments buying Artel. This builds value incrementally within their private holdings. They recently announced a bigger one, Advanced Instruments buying Nova Biomedical for over $2 billion. But again, the goal seems strategic. Build a global leader in a specific niche they know well. They generally avoid splashy, risky public M&A.
Okay, reinvestment, strategic bolt-ons. What about returning cash to shareholders?
That's the third leg. Shareholder returns. A key commitment is a steadily rising dividend, and the track record backs that up. They proposed a 9% hike for 2023, raising it to SEK 4.80 per share, and then proposed another hike to SEK 5.2 for 2024. That signals real confidence.
And buybacks. Do they do share buybacks?
Sparingly. Mostly just to offset dilution from incentive programs. They've explicitly said they prefer investing directly back into the businesses over using buybacks just to manage the capital structure. So overall, their actions seem very consistent with that rational, long-term mindset. Avoid fads, focus on building the businesses, and return excess cash via a growing dividend.
Okay, the report also calls their financial structure a fortress. That's a strong word. But you mentioned holding companies have volatile reported earnings because of accounting rules.
Yeah.
So how do we look past that noise and see this supposed financial strength?
Yeah, that's absolute critical with holding companies. IFRS accounting forces them to mark their listed shares to market value each quarter. So if the stock market jumps, the reported net income jumps. If it falls, net income falls. It looks incredibly volatile on paper.
But it's not necessarily reflecting the underlying business performance.
Exactly. As a long-term investor, you have to look through that accounting noise. You need to focus on the underlying economic engine. And qualitatively, that engine looks very consistent. It's powered by two reliable streams, those steady, growing dividends from the big listed companies, plus the strong, predictable operating performance coming out of Patricia Industries. The fundamental cash generation seems much more stable than the reported net income suggests.
Okay, so we look past the reported earnings to the underlying cash flows and quality. What specific key quality ratios help confirm this strength? How do we measure this financial fortress?
Good question. Let's hit the main ones. First, return on invested capital, ROIC. Now, calculating ROIC for the holding company itself is tricky because of that fair value accounting we mentioned.
Right.
So the real analysis is looking at the ROIC of the underlying operating companies. The memo used Atlas Copco as an example, consistently world-class ROIC, averaging around 27%. The thesis is that Investor AB is essentially a collection of these high ROIC businesses managed well.
Okay. ROIC of the parts. What else?
Second, free cash flow FCF conversion. This really shines a light on the quality within Patricia Industries. The report mentioned exceptional performance there. Major subsidiaries hitting a cash conversion rate of 105% in 2023.
105%. How does that even work?
It means they converted more than 100% of their reported operating profit, EBITDA, into actual free cash flow. It's a sign of incredibly efficient operations, excellent working capital management. Basically, the reported profit is very high quality, translating directly into spendable cash, and then some. It's a hallmark of really great businesses.
Wow. Okay. That's impressive. What about the balance sheet itself?
Third, balance sheet strength. Here, they use a pretty direct and conservative metric. Leverage defined as net debt as a percentage of total adjusted assets. And by this measure, the balance sheet absolutely looks like a fortress. Leverage is consistently incredibly low, typically just 1% to 2%.
Only 1 to 2% debt relative to assets.
Yes. Looking at the data from the reports table, 2.2. 1.2% leverage estimated for 2024, 1.7% in 2023, 1.5% in 2022 and 21. Even in 2020, it was only 2.5%. This ultra-conservative approach gives them enormous flexibility. They can weather almost any storm, and they have the firepower to act opportunistically when markets get choppy. It's also validated externally by their high credit ratings, S&P AA, Moody's A3, that's top tier.
And that same table showed the dividend growing steadily too, right?
Right. From SEK 3.50 in 2020 up to the proposed SEK 5.2 ME for 2024. Strong balance sheet, growing dividend, it paints a picture of financial resilience.
Okay, we've definitely established Investor AB seems like a high-quality operation, unique structure, strong moat, rational management, fortress financials. But the million-dollar question, or maybe the billion krona question, what about the price? Is it a good investment right now, or are we paying too much even for this quality?
Exactly. This is always the crucial step. Looking at conventional multiples, Investor AB doesn't screen cheap. The trailing PE is around 20x, give or take. PFCF looks really high, but like we said, that metric is distorted for a holding company, so probably not reliable here.
So what is the best way to value it then?
The most relevant metric is definitely price relative to net asset value, NAV. Basically, what are all the underlying assets worth compared to the stock price? Historically, Investor AB often traded at a pretty significant discount to its NAV. You could buy a dollar's worth of assets for, say, 80 or 90 cents.
The classic holding company discount.
Right. But that discount has narrowed quite a bit. The report noted it went from about 12.9% at the end of 2023 down to maybe 7.6% by the end of 2024.
So the market is recognizing the quality more.
That seems to be the interpretation. The market is appreciating the value created by that active ownership, by the quality of the portfolio. So the obvious buy a dollar for 80 cents bargain isn't really there anymore.
Does that mean it's too expensive now?
Not necessarily. The argument shifts. The investment proposition is no longer about buying assets on the cheap. It's about paying a fair price, roughly NAV, for what you believe is a dollar's worth of world-class, growing, expertly managed assets. Essentially, you're getting the alpha, the value added by management, and the private portfolio's compounding, potentially for free, without paying an extra premium above NAV. It brings to mind that Buffett quote.
It's far better to buy a wonderful company at a fair price than a fair company at a wonderful price.
Exactly that. You're paying for the quality, accepting that the obvious discount has closed.
Okay, so if the price is considered fair, where does the future growth come from? What's the engine that will drive returns from here? And flipping that, what are the really big risks? The things that could permanently damage value for you as a long-term holder?
Right. The primary growth engine isn't about the NAV discount closing further, necessarily. It's about the compounding of value within the portfolio, supercharged by investors' active ownership and smart capital recycling. Remember, this isn't a passive index fund just holding stocks. Management is actively involved, pushing strategic initiatives in their companies, digitalization, sustainability efforts, operational improvements. They're trying to make the underlying businesses grow faster and become more profitable.
And Patricia Industries plays a big role here.
A huge role. Patricia Industries is positioned as this powerful, privately held compounding machine. It gets funded by the steady cash flows from the listed side, allowing it to grow without public market scrutiny. The expectation is that this segment will be a major driver of NAV growth for decades to come.
Okay, that's the growth story. Now, the scary part. What are those permanent impairment risks? The potential deal breakers?
The report identifies three main ones. First, and maybe the most fundamental, is cultural dilution or erosion of Wallenberg influence. Their biggest, most unique advantage is that whole Wallenberg ecosystem, the long-term culture, the rationality, the reputation. If there's a failure in generational succession, or if the company culture drifts towards short-term thinking, that moat could crumble. That would be devastating.
So losing their special sauce.
Exactly. Second is the catastrophic failure of a core holding. The portfolio is concentrated. Atlas Copco, AstraZeneca, SEB, they're huge weights. If one of those suffered a truly permanent blow, a massive technological disruption, a huge regulatory change, a disastrous operational failure, it would hit NAV really hard. They're champions, but not invincible.
Right, concentration risk. What's the third?
The third is the risk of diversification or value-destructive stewardship. Basically, the risk that management's Midas touch starts to fail. This could look like clinging on to underperforming assets, maybe like Electrolux for too long, perhaps for emotional reasons, Or it could be making a really big, overpriced acquisition in Patricia Industries that destroys value, maybe driven by ego instead of logic.
Like trying too hard to grow.
Potentially. The report mentioned an old 2011 SEC complaint which, while dated, highlighted the inherent risks that can come with highly concentrated power, potential conflicts of interest that could lead to bad decisions if stewardship ever faltered significantly.
Those are definitely things to keep an eye on. Okay, the report then does this interesting exercise, contrasting the market consensus view of investor AB with a more contrarian view. What's the typical market narrative, and what insight might we be missing if we just accept that?
The market consensus view is pretty straightforward. People generally see investor AB as a high-quality, safe, maybe slightly boring, blue-chip holding company. It's seen as a proxy for the big Swedish industrial and financial players, a stable, reliable dividend payer. Most analysts rate it buy or hold. Solid, dependable, maybe not super exciting.
Okay, the safe pair of hands view.
Pretty much. But the contrarian view, which emerges from this deeper dive, argues that this consensus is fundamentally incomplete. It significantly underestimates the dynamism and the long-term value creation happening, especially within Patricia Industries.
How so? What are they missing?
The market tends to value investor AB mostly based on its listed holdings, almost like it's just a tracker for those big public stocks. This misses three key things, according to the contrarian take. First, it misses the private equity alpha with permanent capital generated by Patricia. Patricia operates like a top PE firm, finding and growing great private companies, but with that huge advantage of permanent capital. No forced exits, ability to compound long-term.
Right, the patient capital advantage again.
Second, the market likely undervalues the quality of those private assets. We talked about the 105% cash conversion that signals exceptional quality. It's probable these private assets are marked conservatively on the books, meaning their true economic worth might be higher than reflected in the NAV. There could be hidden value there.
Interesting. Underappreciated assets.
And third, the market often fails to see the self-funding flywheel properly. It's not just a random collection of assets. It's this symbiotic ecosystem where public cash fuels private growth efficiently. This internal capital market is a powerful and likely underappreciated source of long-term value.
So the contrarian view is basically saying, look closer at Patricia Industries and the structure itself.
Exactly. The narrowing NAV discount might be the first sign the market is starting to wake up to this. The opportunity, from the contrarian perspective, is investing now, believing there's still significant unrecognized value in how that private portfolio will compound over time, powered by this unique setup.
Okay, let's try to synthesize all of this. After digging through everything, what's the core one-pager summary? What are the absolute key reasons you might want to own investor AB for the long haul? And what's the strongest argument against it? The bull versus bear distillation.
All right, the bull case boils down to this. First, the irreplaceable moat. You get the Wallenberg ecosystem, that century of reputation, network, active governance, plus the structural advantages of permanent low-cost capital. Very hard to replicate. Second, exemplary stewardship and alignment. You have a proven track record of rational long-term capital allocation, a commitment to a rising dividend, and that unique alignment with societal good through the Wallenberg foundations.
Okay, moat and management.
Third, the portfolio of champions and hidden growth engine. You get exposure to world-class leaders like Atlas Copco and Moat, plus the often underestimated Patricia Industries, that private, high cash conversion compounding machine. And finally, the fortress balance sheet. That ultra-low leverage provides incredible resilience and flexibility. So moat, management, quality assets, public and private, and financial strength. That's the bull case.
Sounds compelling. Now hit us with the bear case. What's the counter thesis?
The bear case also has strong points. First, concentration risk. It is heavily weighted in a few big Swedish industrial and financial names. That makes you vulnerable if those sectors or Sweden itself hits a rough patch. Second, portfolio drag. Those underperforming consumer businesses, Electrolux and Husqvarna, could hold back overall returns if they aren't fixed or divested effectively. They're a potential anchor.
Right, the tale of two portfolios risk.
Third, valuation and opaque assets. The NAV discount has narrowed, removing that obvious margin of safety. And valuing Patricia Industries, which is nearly a quarter of NAV, is inherently tricky since it relies on internal marks. That valuation could prove optimistic in a downturn. And finally, governance risk. While the Wallenberg control is currently a strength, that concentrated voting power, over 50%, is a long-term risk. What if future generations of stewards are less capable? Or what if conflicts of interest arise? It's a concentration of power risk.
Okay, that lays out the core tensions. Now for the final stress test, the red team challenge. Let's actively try to poke holes. What if the whole ecosystem narrative is just, well, a nice story? What's the most persuasive argument that buying investor AB today could be a big mistake long-term? Play devil's advocate.
This is the crucial invert, always invert step. The red team challenge asks, what if investor AB is really just a low-cost levered bet on the Swedish economy and stock market? A bet that did incredibly well during decades of falling interest rates and smooth globalization, but maybe those tailwinds are reversing now.
So maybe its past success wasn't just skill.
That's the core counter-argument. Are we paying a full price today, near NAV, for what might ultimately be little more than a geographically concentrated, actively managed ETF? Are we getting seduced by a compelling, perhaps romantic story about the magic of active ownership that isn't fully provable? Because if that NAV discount is gone, there's no valuation cushion if the narrative breaks.
And the hidden value in Patricia.
The red team says that hidden value could be a mirage, an artifact of optimistic internal accounting, marks that simply vanish when the economy turns down or if they ever tried to sell those assets externally. And look at the real-world evidence. The struggles in the consumer portfolio, Electrolux, Husqvarna, show that the Midas touch clearly isn't universal. Management isn't infallible.
So what's the potential bad outcome?
The potential catastrophe scenario is a bad recession hits Europe, maybe a core holding like Atlas Copco faces a genuine crisis, or the whole portfolio just underperforms for a sustained period. Suddenly, that moat might not look like such a fortress after all. And the investor who bought today is left holding stodgy ex-growth industrial companies with no margin of safety in the price, having bought right when quality investing was super popular. They mistook a great historical story for a guaranteed resilient future. That's the fear.
Wow. That's definitely a sobering perspective to consider. What a deep dive we've had. We've really peeled back the layers on Investor AB. That unique three-pillar model, the powerful Wallenberg moat spanning a century, the financial resilience, but also these critical questions around valuation, risks, and even the portfolio's weaker spots.
Absolutely. We've seen the clear power of their engaged ownership model, the benefits of patient capital, but also the undeniable challenges that come with concentration and managing diverse assets, some of which aren't performing as well as others.
It really underscores the need to look beyond just the headline numbers, doesn't it? To question the narratives, understand the why behind the track record.
Indeed. This exploration of Investor AB drives home how important it is to dig deep, to understand those underlying dynamics, the strengths and the potential vulnerabilities, even in companies that seem incredibly established and successful on the surface. Nothing's ever quite as simple as it looks.
So let me leave you, our listener, with a final provocative thought to chew on. If a significant part of Investor AB's long-term success is truly driven by its permanent capital and its ability to nurture businesses privately, away from public market pressures, what does that suggest about the inherent challenges and maybe even limitations of public market investing for the rest of us who operate without that kind of long-term structure and influence? It really makes you think about where sustainable outperformance, where true alpha might actually be generated.
And turning it back to you personally, what stands out to you most about Investor AD now that we've spent this time unpacking it together?
Thank you for joining us on this deep dive. We hope this is giving you a genuine shortcut to being deeply informed about Investor AB, and maybe even spark some new questions and curiosity for your own investment journey.